Have you ever wondered if a single year could change everything about our global economy? Today, we're asking if 2025 will be that year. And the answers might surprise you. Hello everyone, and welcome to today's discussion. Join me as I dive deep into a pressing question that's on the minds of many economists, analysts, and everyday people. Will 2025 be the year of financial chaos? This isn't just a conversation about numbers on a spreadsheet. It's about the real-world impact that global economic trends might have on our daily lives, our families, and our future plans. In this video, I'm going to look at the predictions, theories, and potential scenarios for the year 2025. Are we headed for tough times? Or is there a chance we might navigate these challenges successfully? Let's find out. Before we get into the details, let's take a moment to reflect on why 2025 is even being called a pivotal year. Some experts see signals that could point to a storm on the economic horizon, rising inflation, ballooning debt, and geopolitical tensions. When these factors intersect, they can create a swirling mix of uncertainty. For many people, these macroeconomic changes have very real consequences. They affect job markets, prices of goods, and even family budgets. But let's go step by step and try to get a clear view of what's going on. First, let's talk about inflation, the rate at which the general level of prices for goods and services rises, which results in a decrease in the purchasing power of money. It might seem like a small, everyday concept, but inflation can have a huge impact on your savings, your plans for retirement, and your ability to buy essentials. If prices grow faster than wages, people struggle to afford everyday items. Groceries, gasoline, and rent can become more expensive, sometimes faster than incomes rise. High inflation can force central banks to raise interest rates. This means that mortgages, car loans, and credit card interest can get more expensive, putting extra pressure on households. Different countries are seeing various forms of inflation, but many are finding it hard to tame. Supply chain issues, rising energy costs, and shifting consumer demand are all contributing factors. Experts worry that if inflation isn't brought under control soon, people could lose faith in their currency. When faith in a currency drops, it can cause even more disruption, making inflation worse. Imagine you've been saving for college or your first home. Inflation could chip away at the value of the money you've put aside. Even if you manage to keep pace with the cost of living, unexpected spikes in inflation can leave you vulnerable. When that happens on a large scale, across entire nations or even globally, the ripple effects can be enormous. Moving on to the next concern, debt levels. Debt can be a useful financial tool. It allows governments to fund infrastructure, and it helps individuals finance homes, cars, or education. But when debt is piled too high, especially if economic growth is slow, repaying or even servicing that debt can become a serious challenge. Many governments worldwide have increased spending to stimulate economic growth. In times of crisis, like global recessions or pandemics, governments may borrow heavily to offer relief programs and keep economies afloat. The danger emerges when borrowed funds don't translate into robust economic growth. When the economy doesn't expand enough to handle that debt load, governments can find themselves stuck with high interest payments, possibly leading to cuts in essential services like healthcare or education. On the personal side, low interest rates often encourage people to take out mortgages or run up credit card balances. When interest rates inevitably rise, those monthly payments can jump, squeezing household budgets. If too many people default on their loans because they can't keep up with higher rates, the banking sector can suffer, sometimes triggering a cascade of economic problems. Picture a situation where both governments and families are overwhelmed by debt simultaneously. That combination can magnify issues and reduce the wiggle room to respond to an economic downturn. In such an environment, even a small policy shift or a sudden geopolitical incident could spark a chain reaction that puts the entire financial system under strain. Now, let's consider geopolitical tensions. Financial markets don't exist in a vacuum. They're influenced by politics, trade agreements, and international relationships. When major powers are locked in trade disputes or other forms of conflict, it can disrupt the flow of goods, raise tariffs, and stir uncertainty in global markets. Even the threat of new tariffs on key products can unnerve investors and push businesses to adopt a wait-and-see attitude. Companies may delay expansion, cut back hiring, or raise prices to offset the costs of tariffs. As countries become more protective, supply chains can break down. Items that once freely moved across borders could get stuck in red tape, creating shortages that lead to higher prices. Geopolitical hotspots can impact vital shipping lanes, energy supplies, or technological components. If a conflict or sanctions limit access to essential resources, like semiconductors or oil, the effects can spread quickly across the globe. Investors tend to flee riskier areas during times of conflict, which can result in currency fluctuations, capital flight, and overall volatility in financial markets. Geopolitical tensions are often called the wild card because they can flare up suddenly. Unlike inflation and debt, which usually build over time, political conflicts can ignite overnight. If they happen in a region that plays a crucial role in global supply or trade, the effects can rattle financial markets in unexpected ways. So, why is 2025 being singled out? It's the point at which numerous trends might converge. Rising inflation. If central banks struggle to contain inflation, living costs might rise, forcing businesses and consumers to tighten their belts. High debt levels. With governments and households already facing substantial debt, there may be limited room to maneuver in a crisis. If interest rates rise, borrowing becomes more expensive and default risks can go up. Geopolitical tensions, ongoing trade wars, resource conflicts, or even political standoffs can create supply chain snarls and scare off investors. When you combine these elements, you get what some economists call a perfect storm. The knock-on effects could include widespread recession, mass layoffs, soaring prices, and plunging consumer confidence. This isn't meant to be alarmist. It's a scenario worth considering so that we can take steps to prepare. To understand what might happen in 2025, it helps to look back at history. The 2008 financial crisis, triggered by subprime mortgage lending and complex financial instruments that spread risk across the globe, 2008 taught us how interconnected financial markets are. A collapse in the US housing sector had worldwide effects. Some analysts see echoes of that crisis today. High consumer debt, risky investment products, and property markets in certain areas looking overheated. The debt crisis of the 1980s and 1990s. Countries like Mexico, Russia, and various Asian nations dealt with severe debt issues. Many ended up needing bailouts from international organizations like the International Monetary Fund. These crises showed that when governments accumulate large debts and something goes wrong, like a drop in commodity prices or a spike in interest rates, entire economies can be at risk. Oil shocks and resource scarcity. Historically, disruptions in the oil market, such as in the 1970s, created major inflationary spirals and recessions. With new environmental concerns and the energy transition underway, it's possible that sudden shifts in energy markets could be a catalyst for financial instability. By studying these historical events, economists try to identify warning signs. we see that many of the same themes, overextended debt, questionable lending practices, geopolitical instability, resurface across decades and can lead to significant downturns if not addressed. Although we've identified several negative factors, it's important to balance that outlook with the potential for innovation and forward-thinking solutions. We shouldn't overlook new technologies and developments that could reshape economies in the next few years. Digital currencies and fintech, cryptocurrencies, and digital payment platforms are still evolving. They could change how we handle transactions, store wealth, and manage financial services. If they become more widely accepted, they might create a parallel financial system that could either stabilize or disrupt traditional banking. AI and automation. Artificial intelligence and automation have the potential to revolutionize industries. Businesses might become more efficient and new job markets might appear in tech sectors. However, automation could also displace certain roles, leading to shifts in employment patterns that might create short-term economic turbulence. Green technology. The global push for environmental sustainability is driving investment in renewable energy and clean technologies. As these industries expand, they could create jobs and stimulate growth. At the same time, traditional energy markets might face increased competition, leading to transitional challenges. These technological advances can introduce fresh variables into the equation. While they offer potential benefits and solutions to some problems, they also bring uncertainty. If these technologies lead to rapid disruptions in labor markets or supply chains, they could feed into a broader environment of volatility. Now that we've laid out the factors, rising inflation, high debt, geopolitical tensions, and transformative technologies, what are the possible outcomes for 2025? Gradual slowdown. We could see a steady but manageable decrease in economic activity where governments and central banks slowly rein in inflation with modest interest rate hikes. Debt might remain high, but as long as growth continues at a moderate pace, major defaults could be avoided. In this scenario, job markets tighten but don't collapse, allowing people time to adjust. We might feel it in higher prices and more cautious business investment, but a full-blown crisis might be averted. A more dramatic scenario could unfold if a major geopolitical incident occurs, such as a significant trade conflict or a disruption in a crucial shipping route, or if global debt markets lose confidence in certain governments. In this situation, confidence can evaporate almost overnight, leading to bank runs or massive sell-offs in financial markets. Layoffs could surge, and governments might scramble to respond with stimulus measures they can barely afford. This type of crisis, if it happens on a large scale, can shape an entire generation's outlook on money, employment, and the global system. Recovery and innovation. Boom. It's also possible that technological breakthroughs, improved trade agreements, and better fiscal policies lead to an unexpectedly positive outcome. Nations might coordinate efforts to handle inflation, rework debt obligations, and reduce international tensions through diplomatic means. Meanwhile, rapid advancements in artificial intelligence, renewable energy, and digital finance could create millions of new jobs, fueling an economic surge rather than a downturn. While this might seem optimistic, it's important to remember that the global economy can sometimes surprise us in positive ways. No matter which scenario seems most likely to you, it makes sense to think about ways to prepare and protect yourself. Financial chaos, if it happens, doesn't just affect big banks or multinational corporations. It touches regular people. Stay informed. Keep an eye on reputable news outlets, economic reports, and policy decisions. Understanding the bigger picture can help you anticipate changes in your job market or living costs. If interest rates climb, Carrying large debts can become even more expensive. Look for ways to reduce debt. Pay off high-interest credit cards, consolidate loans, or renegotiate rates if possible. Diversify your savings and investments. Whether you invest in stocks, bonds, real estate, or even digital assets, spreading your risk across different types of investments can help shield you from a sudden collapse in any one sector. Build an emergency fund. Having 3 to 6 months worth of expenses saved can be a lifesaver if you lose your job or face sudden bills during a financial downturn. This cushion provides breathing room while you adjust or find a new source of income. Develop transferable skills. In an era of rapid technological change, it pays to continuously learn and adapt. Skills in data analysis, coding, digital marketing, or project management can open new opportunities if your primary industry faces a downturn. Stay politically and socially engaged. The policies governments enact can have a huge impact on the direction of the economy. Voting, community involvement, and staying informed can all help you play a role in shaping the economic future. Given everything we've discussed, rising inflation, debt concerns, geopolitical tension, and technological disruptions, 2025 could indeed be a year of financial chaos. It might also be a year of transformation, innovation, and new opportunities. While it's impossible to say with certainty which path we'll take, we can prepare for various scenarios by staying informed, managing our personal finances responsibly, and keeping an open mind about the possibilities that emerging technologies might bring. History shows us that while global financial systems can be fragile, they are also adaptable. People, companies, and governments learn from past crises and often enact reforms to prevent them from recurring. Sometimes these reforms work, and sometimes they introduce new complexities that set the stage for the next crisis. That's why it's essential for us, ordinary citizens, business owners, and students, to keep learning about economic trends and speak up about policies that affect our futures. I want to emphasize that not all experts agree on the timeline or severity of the next crisis. Some believe that the global economy is more resilient now than it was in the past, while others see warning signs piling up. The best approach is to take a thoughtful, balanced view. Remain cautious, but also remain open to positive developments. As we get closer to 2025, the chatter about a potential financial crisis will likely grow louder. By cutting through the hype and examining the core issues, inflation, debt, geopolitics, and technology, we can form a clearer understanding of what might be at stake. Ultimately, whether 2025 turns out to be a year of financial chaos or a year of managed change, we have a role in shaping how we respond, both individually and collectively. So now, I'd love to hear from you. What do you think about the possibility of financial chaos in 2025? Are these concerns overblown, or do you see the signs that a perfect storm might be gathering? Feel free to share your thoughts, personal experiences, or any questions you have. If you found value in this exploration, take a moment to check out my previous video on economic forecasts and trends. It dives into the historical context of recessions and expansions, which could be a great companion piece to this discussion. Thank you for joining me in this in-depth look at the potential financial challenges that might lie ahead. Let's keep the conversation going as we all try to make sense of a rapidly changing economic landscape. The future may bring challenges, but it can also open doors to innovation and growth. Staying informed and prepared is our best strategy, because the decisions we make today will shape tomorrow. Leave a comment so we can keep the conversation